who's more innovative? Is it the mutual fund industry or the ETF industry? And how do you measure innovation? I'm Ron DeLegge with ETF Guide, and we're pleased to have with us Dan Weiskopf. He's a portfolio manager with Toroso Investment. Dan, it's great to see you.
Thanks, Ron, for having me. Thrilled to be here.
So let's start by talking about innovation in terms of the mutual fund industry versus the ETF industry. We've got analog versus digital. So who's doing a better job at innovating?
Well, mutual funds are coming in, right? So we've got to be prepared for the innovation that comes from mutual funds in the ETF industry.
And we also have to be polite too, don't we?
We do. And I would honestly think that ETFs as the future are more innovative. But listen, mutual funds are coming in because they need to.
And so the big thing is these mutual fund giants have been looking at offering semi-transparent ETFs. Tell us a little bit more about that.
Well, the issue is about transparency, right? So, at this point, there's a debate between really the Blue Tractor model and the Presidian and other models. And what we find is that the Blue Tractor model is more transparent. So there may be a slight preference that way.
And so when you say transparency, just tell our audience, what are you specifically referring to? You're referring to the portfolio holdings or the actual product structure? Talk about that.
Holdings. In one model, you're going to get the reporting every 3 months at the tail end, right? Just like a mutual fund. In the other model, you're going to be able to look through and understand about 90% of what you own. That's a value to me.
And so the latter is the one that you support.
Well, we support both models, don't get me wrong. But because we like transparency, right now we think the Blue Tractor may be the better play.
As you know, the failure rate for newly launched ETFs is quite high, with almost 75% of funds forced to liquidate during their first 2 years of their launch. Is innovation merely a function of which ETFs among their peers manage to survive?
Yeah, there is survivor bias, sadly, I have to say. And the trend in this case is not, my friend. It's hard. It costs a lot of money to launch an ETF. Let's face the reality there, right? Everybody wants low cost. Everybody wants
How much does it cost?
Access.
How much does it cost? Curious minds want to know.
Curious minds want to know about $250,000 to launch an ETF.
Okay. And that's the seed. What about the seed? That's seeding it.
You've got to get the seed. You've got to sustain it. So the question ends up being, what do you start with, right?
Yeah.
What we tell people is you got to start with $30 million at least and have a sustainable plan to get to $100 million. But it's not just about being there. It's about the strategy.
Let's talk about measuring innovation, because I know you just wrote a great white paper on this. It's really hard to quantify innovation, but you're a stubborn guy who doesn't take no for an answer. And that's, by the way, why I like you so much. And you've invented this new metric that attempts to measure ETF innovation. It's discussed in this latest white paper. Tell us a little bit more.
Ron, thanks for the recognition. I do appreciate that. And it is a challenge. There's a lot of subjectivity to what exactly is innovation, right? But what we found was since 2009 through 2019, the products that are doing something clearly different and have some sustainability in terms of what they're offering, meaning that they are providing access to a different strategy, or they're doing active management, or just a complete different type of strategy that hopes to generate alpha. That is what innovation is. What innovation is not is just providing lower cost. That's already there. And what we seek to measure is the asset growth and differential between those two categories, we'll say, low cost and ACAI.
So is there a correlation between innovation and the raw number of ETF product launches? For example, are the firms that launch lots and lots and lots of product, are they more innovative by definition versus the firms that launch fewer products?
Yeah, I would not be a great believer of the machine gun approach. You've got to be very well targeted. And then again, going back to the whole issue of, you've got to have a strategy around your marketing, right? And everything has to be client-centric. That's what we're all about at Toroso and Tidal. If there is not client alignment with the product and demand, you are going to fail.
And when you say client alignment, you're referring, what I hear in my mind when I hear that is clients have a basic need or they're trying to solve a problem.
You're trying to solve a problem. That's exactly right.
So,
and to that point, Ron, sorry to interrupt you.
No, go ahead.
Low cost is already there. There's no problem that needs to be solved with that. So what you are seeing is certain custodial platforms still coming to market because they can fill that need and reach profitability that way. And there's nothing wrong with that, but that can't be the driver of innovation.
So what's the key takeaway, Dan? How do you envision advisors and investors using your new metric for gauging ETF innovation? How does it help them?
It helps them because I want to get away from the whole discussion about free beta and low cost. And if they start looking beyond the cost issue, they'll find that there's lots of innovation around. And then they might find different ways that they could innovate themselves in their practices using these solutions. Because what we do know is that the world is changing, right? Markets are changing and solutions need to change as well. The market cap weighted methodology may work great, but it also may have a lot of legacy zombies in it, which is something that we are telling people to be wary of.
And especially with the toppy market like we've seen in 2020, that could certainly, and we've seen this in the past in the late 90s, when we had very similar year after year top of the line performance for major indexes like NASDAQ and S&P 500, eventually that momentum, and really market cap weighted, when you think about it, it's a momentum type of indexing methodology. Would you agree to that?
I would agree with that. Yeah, absolutely. And it is by that definition momentum because the largest companies are leading the performance, right? And that works great, but when it doesn't, you better watch out for the falling knife.
Right. And so thinking ahead and being prepared for whatever that next cycle is, that's what investors and advisors need to be thinking about.
Yeah, I mean, you should have a core satellite approach to things, right? The core can be free or it can be low cost, and that's wonderful. Yeah. But have an approach that is very targeted with what is new in the markets and what trends exist with that.
Well, Dan, thank you for taking the time to drop by and for those wonderful insights. Hope to see you soon. Again, you just heard from Dan Weiskopf, Portfolio Manager at Toroso Investments. I'm Ron DeLegge. Thank you for watching ETF Guide TV, and join us again next time.
Thank you, Ron. Thanks for having me. Structure matters.
Take care.